Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
My guest this month may be familiar to listeners in the UK, but probably not to those in the US or further afield. Gary Channon runs a value fund, a closed-end fund and a private equity vehicle here, and I asked him on the podcast because he is really thoughtful about his investment process. He runs highly concentrated strategies. The top 5 positions are over 50%, and he holds no more than 15 stocks. He has a very rigid process where he will not buy a stock unless it's trading at half what he thinks it's worth. But he will hold those stocks for extended periods. He's quite happy not making changes to the portfolio in a whole year. I hope to pick his brains on his investment process because he only buys stocks where he can monitor the business performance independently. That's a highly unusual characteristic. His framework for evaluating stocks includes parameters like the depth of work the analysts have completed and their confidence levels. Again, something quite differentiated. And he's instructed his entire research team to become AI experts, and they have already seen significant benefits. He thinks AI means sellside analysts will be more or less gone in just 2 years. We also talked about his techniques for interviewing management, which includes spending 4 to 6 hours preparing for a 1-hour meeting. It took me a while to tease out some of Gary's secrets, but I ended up learning a lot, especially about those management meetings. I would also love to get your feedback. I normally record in my office, but I've lost the services of my wonderful sound engineer, Rose, who works here. And rather than do the sound myself, I'm using a nearby facility in a canal boat. Check out the show notes on the website for some photos. Let me know if you can hear the difference. Thanks as ever for listening, and I hope you enjoy our conversation. Gary Channon, welcome to the podcast. Did you always want to be an investor?
I sort of got into it by accident. I was at boarding school, and in the library, the FT was there, and nobody read it, probably because it was pink and it was an all-boys school. Sort of fascinating.
What school?
It's called the Royal Hospital School. It's for the sons of people in the Navy. My parents are in the Navy, so they were all children of seafarers. So I was fascinated. It was full of numbers, and I would have been 11 when I first went there, 12. So that's how I got into it. Had a very lucky start. First investment ended up making a lot of money. Oh, well, actually, second investment made a lot of money.
Well, what was it?
Polypec, which turned out to be a fraud. My first investment, I just wrote to the bank and I said, can you buy, and I read it in the Sunday Times, it said this stock was going to go up. That was Johnson and Firth Brown. It was sort of 17p, and I said, can you buy me 10 shares, £1.70, and I had like £8 in my account when I was 12. And the bank should have probably just thrown that away, but they actually did it and wrote and sent me actually the certificate and a very nice letter saying, you can't sell these shares until you're 18. We bought them, and normally our minimum commission is £5, which will slightly wipe you out. So you might want to sort of get some more money, before, and also maybe some reading. And he sort of recommended a book. Unfortunately, wasn't an intelligent investor, and so I borrowed £50. My dad, and there was a book in the library about how the stock exchange works, one of those terrible books. but it did say try to find things that are in your domain. And my family owned a post office stores in Devon, and I would read everything. So reading the Convenience News, and Polly Peck had bought Del Monte, and so I thought I had a bit of specialist knowledge, and I bought Polly Peck, and £50 actually turned into nearly 2,000. And I tried to sell it when it was like 900, and because I did it by post, by writing a letter, by the time it doubled again, by the time they got the letter and done the trade. So it turned out later, when I was working at Goldman, to be a fraud and delisted. But that got me. And so throughout my sort of teenage years, I was one stock at a time. But this was Thatcher's privatisation era, so I would just snag every privatisation, put all my money into each one, and just compounded away. And my best track record ever is those teenage years, because by the time I stopped, it was about £50,000, that £50.
Wow.
And I'd never had any diversification. and the 15-year-old Gary is probably the most confident person he's ever been. The rest of my life has been sort of roll back at that confidence. But anyway, so that's how I got into it, into investment.
And what did you do with the 50 grand?
Life got a bit complicated for me. I got expelled, and that was the end of my education. I went home to help my mother. My parents separated just after that, and so essentially supporting my family. I did something else that I thought was clever. I put some into a gold fund. I'd read something and thought I knew what I was doing. That was a mistake, because when I wanted the money out, I had to pay all sorts of costs to get it back out. And, but yeah, so that was my glory years, 11 to 15.
How funny. And how did you end up in the city? You started as a derivatives guy.
I didn't start as a derivatives guy. I became a derivatives guy. And it's probably quite important. I hadn't realised. I was a chess person as a child. I played a lot of chess, and I'd have had a chess brain. But so I wanted to work in the city. I mean, this is going to sound awful, but I wanted to be a lorry driver. My granddad was a lorry driver, my uncle's a lorry driver, and I thought that's the best job in the world, just driving. Couldn't actually drive, but it looked like the best job in the world.
Why is it the best job in the world?
If you like cars.
All right.
It's like, and also it's sort of know people, if you knew me better, just kind of, on your own, on the road. Anyway, my mum said you'd be a bit more ambitious, and I went away and I thought, oh, what's the best job in the world? Oh, being in charge. So I said, I want to be Prime Minister. So, okay. I mean, she treated me seriously. I imagine she was probably laughing on the inside, but I thought I needed to be, and she would say about politicians being corrupted and all that. And so I decided I need to be a millionaire first. So in my sort of roadmap, I was going to go to Oxford, study PPE, go into the city, become a millionaire, and then go into politics. That was the model. So yeah, expelled at 15 was slightly off track, but I hadn't given up. So my thought was I'd go into the city. So where I worked as an agricultural merchant, I got them into doing some grain hedging. So, but I kept applying for jobs. So I applied 1987. So it was a bubble time. There was a real shortage of people. They were hiring anybody. I had no CV. I wrote a single letter, said, here's my IQ, and this is something about me, but I have no qualifications. And Nico saw me, and some of the people there later told me that they recommended not hiring me, but the Japanese liked me. I got hired as a Japanese government bond trader, which in those days in London was a market-making role, but all in Japanese. So that's how I started. But then the way the Japanese government worked is it didn't allow derivative trading in Japan, but as a way to prepare the Japanese to take on the Americans, they allowed them to start doing it in London. So we issued bond warrants, and they allowed the big four. And I got that task. So I learned derivatives the hard way by building a model. And then I went to Goldman to do equity derivatives and do it properly. And Fisher Black was in our team. And but yeah, that's how I got into derivatives. And it's a completely different mindset. It's a probabilistic mindset.
And were you still investing at this time? Were you still investing in your own account?
No. I do probably the occasional PA trade every 2 or 3 years. And it would be some extreme event, like in those days, BP cutting their dividend. And I just read Morgiano Miller, and like dividend policy doesn't relate to value. And I didn't know Buffett at that stage. So but no, I didn't do any PA trading.
And so how did you end up running
then-
money?
So when I went from Goldman to Nomura, as to run equity derivatives, and a big part of that, what we were doing is arbitrage program trading. And the way that we would provide liquidity to customers was that we'd fold it into a pot of stocks around the world, and then we would hedge with futures, and then we would deal with tracking error. So I built all these models for these to deal with that tracking error so we could run that business. But we were in the UK systematically underperforming. We were getting picked off. People would say it's a passive portfolio, but they would stick their dogs in there, and my traders would end up losing money. So I went looking for a stock picking module really to improve our models. And I'd vaguely heard of Buffett, and I read the Lowenstein book. So 1995 had an absolute epiphany. That just, it just made so much sense to me. I just absolutely loved it. Not only that, just the way that Buffett goes about life and business. And I suppose I was searching for my thing. The reason I moved to Nomura from Goldman was to accumulate my own capital, go and work for myself. But I wasn't quite sure what that was going to be. Then I knew what it was. And so I spent a couple of years using Nomura's money to teach myself and do like a value book, and started with ratios and bought textile businesses on low P's and low price to book and things like that. And when I thought I got it, which will sound incredibly hubristic and arrogant, but in sort of 1997, then I resigned and started Phoenix.
And you did that just with your own money, or people actually gave you money?
Well, they did give me money, but I left it on the basis that I'd do it with my own money. Bonuses I'd accumulated, and I was a good leader. I had some bonuses to come. I hadn't thought about the raising money a lot. I thought I'd be from home. I'd be a one-man band. And while I was setting up, Chris, who was the head of, Chris Broadhurst, who was the head of sales at Nomura, came and said, "Do you want any help raising money?" I said, "I haven't really thought about raising money because I only want to raise 100 million and do that." So at the beginning, it was people who knew me and were willing to put some of their own money in, and some of those investors I still have them. But it was a lot harder than the business plan we built. I wanted to launch it with performance fees only, and the regulator said, "Well, where's your revenue?" And I said, "Well, we're going to perform, or what if you don't perform?" And so we had to have a management fee. But the plan didn't go anything like the business plan. But after 2 years, we were closed. We've got the 100 million. We've had a stroke of luck. A lot of value investors were getting fired, and we picked up an institutional account, and then much more because of that in what had been sort of 2000 years.
And so we're now, 26 years later, and you've got how much under management?
About 1.6 billion. For almost 10 years, we didn't need to go and raise money, but the person I'd closed out to, who took 80% of the capacity, it was a slightly foolish thing because they were all mature pension schemes. So if we outperformed, we got trimmed, and through time we got trimmed anyway because they were being turned into bonds because they were closed schemes. So it's not the place where you should close your capital where it doesn't compound. But they were a certain type of advisor, Stanford Associates, Nathan Gilbert, absolutely brilliant man, and but his way of selecting managers who were country focused went out of fashion for pensions, and he was losing clients, and so we were, and then so I went out in 2009 and reopened, and went to look for capital again. Had 1 year, raised nothing. Was about to give up, and then things started to unfold. But yeah, that's the we don't really like raising capital. We would want to just compound the capital we got.
And you developed this very distinctive process with 3 components: business, management, and price. So I think price is very straightforward because you want to double your money. We'll come back to valuation later. But the management and business, well, first on the management, I mean, what do you look for when you look for in a management team?
I suppose one of our thinking frameworks for businesses is it's a pot of capital with a strategy, and that makes returns. And what sits between you and those returns is management. So the first thing we look for is integrity. I mean, absolutely. So we don't go beyond that. So we want to, and not because we think people are stealing money, it's just how they report to you. If you're not getting honesty, then how are you making any of your judgments? Then we look for alignment. So we want to understand what makes someone tick. Are they motivated? And are they motivated in a way consistent with shareholder return? And then the final bit is competence. Now, this is the piece I underplayed. I thought, and I took sort of Buffett literally, if the business is good enough, it sort of takes care of itself. But actually, exceptional management makes a difference. But our base was, are they competent? Do they know what they're doing? And then that's the three ingredients.
And what about the business? I mean, what makes a quality business for you?
All value investors are trying to do the same sort of thing: is make their judgments based upon value rather than what the stock market's doing. And for me, I had a penny drop when I properly studied Buffett. So when I really got into what he was saying, because we know, and we're a kind of investor that wants to buy something as if we're going to own it forever. So we're not trying to anticipate how it might be valued in the future. We're saying, if I own this forever, what's it worth to me? So that's a look into the future based upon the information you have today. And Ben Graham grounded that a lot in the balance sheet and the things that are in the financials, and Buffett kind of updated that and said a lot of the good stuff's not in the financials. And it's the return on capital. If you're going to own the business for a long period of time, if it doesn't have a high return on capital, you're not going to have a successful investment. Return on capital, marginal return on capital, enduring. Businesses don't decide to have low returns on capital. It happens to them. So if someone's doing it enduringly, then they've probably got something that Buffett called a moat. So do they have a moat, and do we understand it? And so we're looking for a certain type of business which we think lends itself to having a stab at what the future looks like. So where we can extrapolate some of the past and build a horizon of future value, and then handicap that and pay a discount to it. So our business process does that. So yeah, that. I say a bit more about the process.
And
you're going to ask me?
Well, you've talked about intrinsic value being like your North Star.
Yes.
And what I think is quite interesting is when you've got a very long-term time horizon, you're buying businesses when the share prices are depressed. So you're trying to buy good businesses. So by definition, you're buying them when something's gone wrong.
Yes.
And you need to normalize the earnings in that case, because you're saying we've got temporary. So how do you do that? Because you've got quite a range of different businesses in your portfolio, right? So what's the process? How do you think about this?
Yes. Okay.
What's it going to? It's got a temporary problem. It's made these returns in the past. We think it's going to get back to that in the future. How do you think about it?
So you're right. To get opportunity, the value needs to be obscured. And we need to have we have something that anybody could have, which is a very long-term perspective, but most people can't operate like that. And even if they can't attract capital that will have that patience. But the other thing is, how do we build those models of the future, that intrinsic value? So something like a logic cascade. There are certain things you can extrapolate into the future with some confidence. So we talk a lot about the sort of the Buffett inspiration and all of that, but a big part of what goes on at Phoenix is the psychology side. So Kahneman and all of his universe. My wife's a psychologist, so trying to figure out the future. So we start with this, and people do this without even realizing it. They're assuming that capitalism prevails or the rule of law, but really, how do people live and how do they transact? So household formation, population, demographics, something like that. You could have a reasonable stab at what happens. And you look at the way, say it was, we were doing a house builder. You'd start with what's the population, and then it's actually households and household formation, and then how do people buy houses? And if they can't buy, they can rent. And you build this logic cascade, And then you get down to the competitive landscape. So how does it work? And then how does the business model work? And so we look for things where we can have a stab at having a reasonable chance of projecting that future. So you need pricing power. Businesses need to be in control of their economics. So, and that really improves the probability of you getting the future right, we think. So we've narrowed it down into a very, a very specific type of business. So, but the type of pricing powers that we tend to find are the ones that aren't obvious to people. It's not like Coke. It's not a brand. House building doesn't obviously look like it's got pricing power, but ultimately that's what we look for. And then you're trying to look into the future based upon what you've got. And then we'll build those valuation horizons. And one of the things we really care about is worst case. So we want to test the downside because we get very concentrated positions. And then you have horizons of outcomes. But very few businesses that we look at, we can do that with. It also takes us a really long time to do it. So what a big important part of our process is we separate out doing the research and doing the investing. We collect things that we'd like to own, and so we're ready when they become at the right price.
But I mean, pricing power. I mean, I look at your portfolio. I mean, I'm struggling to see pricing power. Does Michael O'Leary have pricing power? I mean, he's got low cost,
yes,
so he doesn't have pricing power.
So I suppose the way we define it, and so at the heart of Phoenix, there's something called Dream, which turned out to be probably one of the most brilliant things we did. But like a lot of the brilliant things at Phoenix, it was an accident. It wasn't a thought through piece of genius. It was for some other purpose, and then it worked out. So it's control your economics. Low cost producer is one of those. It's the weakest. It's not like being a monopoly. An unregulated monopoly is the best, or a patent or a brand. But being the low cost producer allows you to control your economics. So down to a level. So that's a different that's a form of pricing power.
Well, Dream, does it stand for something?
Yeah. I mean, it was actually called helicarnasis because I did it first one in Bodrum, and that's Bodrum's old name. But it means dynamic relative evaluation and assessment model. So my first hire, I planned to be a one-man band, and I got all these segregated accounts for managing £100 million, but it's just me and Chris. And I spend until early hours doing the admin in the evening, and the auditor was incredibly efficient. So I hired Charlotte, who's still my number two, but the admin for her took an hour, and so I had somebody who knew accounting and was very capable and smart. So we started working together. Now she's a glass half empty person. So we would say, what I would say is good and what she would say is good. And so Dream was a way of us agreeing on assessments. And so we took all of the components of our evaluation process and we separate them. And the manual tells you how to score them. And it tells you how to score them as a rating. And then you do depth and confidence, because I found that the rating would be lower because of a lack of depth or lack of confidence. These are separate assessments. So I thought if I actually draw, we'd say, this is what is a 10. She said, I never give anything a 10. So it says it's a 10. So that's what Dream was. But it turned out to be something very brilliant because it forces us to do the same assessment with every company rather than just assess the available information.
And what, you come up with a score at the end?
Yes. You score, and they're all weighted. And so a AAA is something that scores a weighted 7. So most of the factors are where 5 is the average business and 1 standard deviation is 3 to 7. And a weighted 7 is what's an A. So we try to, we say collect AAs, businesses that are an A, managements that are an A, and then we're waiting for the price event to happen. But we'll look at ones and say it's a single A. We like the business, not this management team. We're waiting for the management to potentially change. But that's what it is, yeah. And then it's Socratic. 2 people need to do it. So the idea is you talk about it. Mm-hmm. We've been doing one recently where the market definition is really hard. And you've got to do this market share, market potential, and it forces you to have the discussion. What information have we got? How do we define it? And then you put down your rating, and and it allows us to continuously improve, because then we go back. Because when we make mistakes, I find you go back and say, what have I got? I've got some notes. I've got what I think I thought. Whereas dream means you've got quite good information about where you got wrong, where your assessments were.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information.
So you're documenting your thoughts at the time.
Yes.
And you can then, and presumably you've got quite a few companies that you've done this for.
Yes, and there's different levels. So to do a full dream process, so if it's me and an analyst doing because it's a series of, we'll have an hour on a factor.
Mm-hmm.
So it might take 4 or 5 months to do one, and you can only go into these factors if you've already built the expertise. So the idea is, and there might be 3 people in the discussion, so it might have taken you a year or so to get into the position to be able to have the discussion, to be useful, to be able to rate something. But when you're in the early days, you have no confidence and depth. You still got to have that. So we don't make any investment that hasn't been through a dream assessment, but the full, longly documented one that could still happen after you've made the initial investment.
So you might do an initial assessment, think this looks good, the share price is right, so we'll go in now and we'll do more.
Well, what I'm going to say is we would have we'll have made the assessment, but if we don't own the investment. Burberry, which we bought last year, which you talked about. So for 10 years, it's in the process, it's in the system, it's gone in, and we've thought about it in a dream way. And we've got our assessment. So when it goes in, it's like, well, what is it? It's a potential AA, potential AAA. So it's a potential AA. We're verifying. And you can always produce that, what we call a snap dream of what that scoring is. Once you own it, then a proper formal dream needs to be done. And what's called a rating square, the 9 numbers that you get from, the rating, confidence, and depth for those 3 factors, business, management, and price. That's done and then updated and maintained every time there's a new piece of news or change. So those only happen once you have the investment.
And
otherwise, we'd be doing it on the whole candidate universe of 100 stocks.
So you only learn from your mistakes on the ones that you actually make investments in.
Well, I mean, in those ones, they're very well documented. But I mean, the other learning of the thing. If we discard something, we write discard notes. We're writing to a future analyst, picking it up and saying, why did we discard it? If you discard something that's a winner, then there's some information in those discard notes.
And how would you arrive at that learning? Only if you were thinking of buying it again, or do you sort of periodically go through and say, here's the best performing of the ones we've discarded. What did we miss?
There's something very interesting at Phoenix, which is strange for people coming into it. Everybody's an island, and so I can write a dream, you could write a dream, and they can be different. You're writing a note, I think, to your future self, and encourage people to go back and read what they thought, because all that you keep seeing is your own naivety. See how much you changed from a year ago or 5 years ago, and how much you thought you knew and you didn't know. So that's what it is. We try to get the learnings of. So you'll have seen a number of people have talked about how the aviation industry is very good at learning from its mistakes. versus
Thankfully, yes.
versus healthcare, which is less good. And part of that is the way they investigate accidents.
Yeah.
So we've done a few of these where we've got somebody from outside the team with somebody in the team who wasn't involved in the investment to do a proper post-crash, post-mortem on an investment that's gone wrong, to try to get access to all the emails and all the information we've had to see what lessons we can have. So yeah, we do in that sense. You learn quite slowly. We're just dynamically going back. No investment unfolds how you expect it. There's information all the time you learn.
I mean, you get things wrong a lot. You can't afford to with such a concentrated portfolio, surely.
We get. I mean, there's two types of errors. There's the errors we made in our assessment or judgment, and then there's the world unfolding differently to what you modeled. So we're constantly updating our view. How I think about it, we're trying to figure out the world, and every day new information comes in. So it's like a Bayesian process. You update it, either how the world works or your assessments. So we build roadmaps for our companies out for 10 years, because although you tend to model lines, you expect ranges. So we try to do that for all aspects of the business and the management. And then we test the news every day against, is it on or off roadmap? Are we bumping at the curb? So to tell you the world's not unfolding the way you thought. So, but the true overall error, our starting point is, do we lose money? So I think we have a low error rate, and it's declining through time. So we've been measuring from the beginning our strike ratio. So how many times we lose money versus make money. So by number, it's just under 80%. Now that doesn't mean that if you make 1% a year over 5 years, it's not a success. It's a failure of sorts, but you still got your money. But by value, it's 95.5. So 5%. So I think that's a really unusual error rate, and that's because of the quality of the work, the investment team. And that should be more alpha. We've averaged 6 or 7 points of pre-fee alpha. That's because of my poor portfolio construction. I think the error rate, the quality of the judgment, should result in 10 points of alpha. And that's me just learning the weaknesses in my own efforts.
So you think your portfolio management, your position sizing has improved over time?
My biggest weakness is selling. So I think I'm sort of personally wired to be contrarian. I would like, we like to say we're independent minded, and I think that's true. But I also don't like being in crowds, and so I think that's good for buying, and I think the buying's got better. I mean, I think in the last 10 years I've only made one investment, but I don't think we made money. So I think I got better at buying.
You just one investment, you won't make money. How many?
Out of 11.
Out of 11, okay.
Yeah, we're not very active. But that's an improvement on the past, and it'll be more by value. But my weakness is selling. So if you are going to buy an outstanding investment at some point, and for a long part of it, people are going to agree with you. And that's a problem for a contrarian. So our track record would have been better over the last 25 years if we'd never sold anything. And that's true of every year's portfolio, and I've improved it. The first 10 years was appalling. But in the next 10 years, I'd improved it so it was neutral. But our biggest mistakes are those things. We own 20% of Games Workshop. If we still held the 20% of Games Workshop, it would be over £1 billion of value and stuff. And really, there was nothing in what happened at Games Workshop that forced us to sell.
What made you sell?
There was a change of leadership from Tom to Kevin. No, there was I was concerned because it was Mark Wells, and then so the way the leadership change happened slightly, I interpreted Kevin wrongly. When I was reading, he was using the word "I," and some things that which actually, if I'd gone and looked, it turned out that probably shouldn't say this in the public domain. I think Kevin's dyslexic and he wasn't writing his own reports as much. And at the time, he turned out to be absolutely brilliant. But the thing was, he was handing back all the money. They changed the rule book. They upset all of the existing die-hard fans by completely simplifying the rules. Very bold thing to do. And the thing is, I didn't need to act on that. In fact, when I saw Tom, not long after we'd been selling, and also the price had gone up. So there you are. Everybody agrees with you. It's a great investment and it's gone up a lot. And incredibly high marginal return on capital, just a wonderful business. And but at that time, they'd been going sideways for quite a long time. And I worried that he was messing it up. And what happens is the high price seduces you.
Yeah.
If he was messing it up and it was trading at halfway you bought it, you'd probably persist and you'd do more work and you'd figure it out. Anyway, I learned from that. We don't sell so easily now, but that's by far the worst thing I've ever done in 26 years.
Well, so you made good money out of
well,
position.
I think you only get handed in your track record will be at the end of 50 years or 60, whatever it's going to be. I'm going to live to 100, but I'm going to probably take it easy in the final 10. So I'm 57 at the moment. So it'll be dominated by 3 to 5, one of those that you held on to. I think when I look at the great records, but you only find them because you're in the game, because you're there looking for them. And that was what I missed.
You always buy it back.
I can't undo the error.
No. No, you do things like mystery shopping.
Yeah.
So, I mean, that's quite unusual for a fund manager. Talk to us about that. You use your relatives.
We use everybody. Again, this is one of the things that we do, which is, I think, gives us an edge, that happened by accident. It wasn't a stroke of brilliance. So we're very Phil Fisher inspired. So scuttlebutt. That's always been the case. Go out and get information, get first-hand information. We don't use anybody else's research. So everything we do is primary. We're trying to figure out how the world works. Why does somebody go in that shop and not that shop? Or why do they buy this and not that? And when I closed the fund, Chris launched he had no job. We hadn't really thought the business through. What would happen if we didn't need a salesman? And I had a salesman. There was only 3 people in the company, and one was a salesman, and we were close. So he launched the fund. He hired a couple of graduates, and then at some point we closed the fund, and he left after a couple of years. And I inherited his graduates. What am I going to do with these? I said, okay, you can go out and shop, go mystery shop. And then we made a virtue of that, and so we do make these like very long-term predictions of cash flows, but then we check in real time. So we only invest in businesses that have the transparency that allow us to see it separately to what management's telling us, and that rules out lots of businesses where we just can't do that. So the mystery shopping is about that competitive. If you saw the rise of Sports Direct against JJB, if you look at our notes, we were going into stores on the same street and JJB didn't have the stock and the Sports Direct was full and they were selling the same product at a lower price, and you could see the battleground. And I suppose that's what we're trying to see. We're trying to see business in real time, in action, looking for signs that our hypotheses are wrong, or confirming our hypotheses.
And I mean, any examples other than, I know it's an interesting example, any other examples where you've done mystery shopping, for example, when you're looking at an investment and you say, oh no, we don't want that. I mean, anything where you've challenged a sort of conventional thesis through the mystery shopping?
Yeah, that's I mean, that's what happened. So we would we would go out and talk to builders about Travis Perkins. So we were working on Travis Perkins for a long time. It was in our process, and all the time we would hear that they were not the cheapest, and it would bother us. So what's the edge? They're expensive. That's a vulnerable position to be in. Yes, they're in the middle of town and all these things, but so we didn't invest. And they would say, look, the builder's not paying the price. It's passing on to the customer. That's not what the franchise is. It's the advice. It's all of these other things, availability of stock, and we give them credit terms. We fund their business. And then along came the financial crisis, and then when we went out and tested it, people were still saying Travis was expensive, but they were still using it, and it sort of proved it. So, and it doesn't quite answer you for rejecting, but we rejected. But then we saw that, and actually they gained share in 2008 and 9. So if you gain share when the world's ending and people care about price, then actually we've got it wrong and we changed.
And I mean, you do this incredibly detailed work. I was quite impressed when I first saw you speak at one of the conferences. You were talking about EasyJet and how you went through the timetables. And with Barrett, you used to scrape their website and visit lots of sites. And I mean, you still own Barrett, but you're now using AI to help. So can you talk a bit about how you do that? And or I don't know if you're willing to.
So yeah, I mean, there's a lot to figure out in house building. Then you're figuring out what do we monitor. We would monitor enough sites. I mean, at one point we'd done it to extremists, but I mean, we've been doing it since 2008, tracking Barrett. And then Barrett used to joke that if their accounting system went down, they'd call us to find out how they were doing. So we get sales rates. We got a lot of other local colour. So we put ourselves in a position when we go to see managements, we know a lot about their business. So and the right kind of managers like that, they respond well, but some don't. But it unearths a lot of information. So by having enough of them, we can estimate sales rate. We can see what's happening with price. But also we can get some local colour of problems. Like now, we might pick up Barrett Redrow integration issues that are going on at a site level. So we still do a number of sites, but what we've been able to do is build a tool that just scrapes all of the sites. And so now we have an almost very real-time idea of what their sales rate is. And most of the time that doesn't matter, but it can matter in extremis. So again, financial crisis is a good example. Everybody thought the world was ending. And our work would say, around London, that's what would happen. The activity on the visits on site just stopped. If you went to Fulham Reach, there was like nothing going on. People weren't visiting. But as we got out of London, people were unaffected by it. By the time you get to Yorkshire or something, there was just no effect. The effect was the World Cup. It wasn't the financial crisis. So that's really useful if you're acting in the cheapness that's in the market. Markets assume the world's ended, and you can see that it hasn't. Nothing's changed.
So, when you're doing this, like the data scraping, does that sort of tempt you into making short-term trading decisions? Because you kind of know that the results are going to be better or worse than the stock market is anticipating.
No, and I suppose in the first sort of 5 to 7 years, I would have this set of results is going to be a catalyst. I'll increase the holding just beforehand because I can see it better than everybody. And I would generally say, especially Barrett, I will read a set of results at 7, say, oh, they're decent, and the shares are more likely to be down. So the people would always ask at the beginning, well, what's your catalyst and stuff? And they think, I have no idea. Usually if we buy something, it tends to go down. And we got a little bit better recently on that, but it doesn't matter to us. But no, we haven't. I've never done anything short term other than change my mind. So at the beginning of the financial crisis, we were making investments that actually at some point something and change your mind. Well, then we're out quickly if we've made a mistake. But no, we never try to anticipate price change. I think we'd be very poor there.
But you've got the information.
Yes, but whatever game you're in this investment, I think you've got to know what your edge is. And then you're on this long journey of continuous improvement. So, so part of it's your process, as you talked about. So our process has got a built-in feedback loop. So we get better through time. The checklist, the filter gets thicker as we learn. And so we keep playing that game again and again. I'm very influenced by Kahneman, but Kahneman had this debate about expertise. And he didn't believe in financial services there was such a thing as expertise. The domain was so big that actually you couldn't build up expertise. And Gary Klein is another psychologist who's a real expert in studying expertise. And he'd studied chess players, he'd studied paramedics and firemen, and they actually had a bit of an academic debate, and then they came together and figured it out. I was quite influenced by that they agreed that in financial services, in anything, if the domain is specific enough, there's a robust feedback loop.
Yeah.
So that's what we try to do. If we do the same thing again and again, we might get better at it. If we start drifting off into other stuff, then we're at risk. So that's what I think. So if you're in a game of anticipating share price, then that's your thing. And there'll be people who are good at that and they figure it out and they'll spend their life doing that and they'll have their edge. But I know what our edge is, and it's not that.
And one of your edges is going to be AI, right?
I think AI is going to be amazing for us. We've been using it. It augments us in a really incredible way. If you think what we try to do, we go out there looking for a certain types of kind of building deep expertise, enough to be able to make good judgments. We've already got at the center a way of putting all that information in a way that it can be utilized to make decisions. So we will be way more productive with it. And then the monitoring tools, like you said, instead of sending someone out, there's a lot of stuff we will be able to automate. So our error rate should go down. Our candidate universe should grow. We should get more alpha is what I think from AI. But it also means it's very complicated looking at companies because they're going to get disrupted in ways that we probably haven't even thought about yet.
And I mean, you've had all the team working on AI.
Yes, I mean, one of the things I did was I gave them all a little envelope, and in it was a name, a Phoenician name based upon a famous Phoenician, and an agent that they needed to build. And the agents are either searching for ideas, or they're part of our DD process, or they're part of monitoring. So in order to be able to upskill themselves to do that, they've had to learn all the available tools and build these agents that will then feed into our process. So by doing that, that also makes them very aware of how much that feels changing. Because in that, if you look at where we do that work, so there's new stuff coming every couple of days. There's things that we were having to do manually, 3 months ago that are now in the latest versions of the tools and stuff. So, but yes, so that's that. Everybody is AI. I say proficient. That's a bit. It's too early to say that, but it's a very important part of our process.
And you've been doing this yourself.
Yeah, I mean, I'm very curious about anything new. So I've been on it for a while. I had a year last year where I was with my mother, who unfortunately died at the end of the year. But I was using it for all sorts of things to give myself expertise, initially to optimize soups. But by the end of it, something very profound happened for me, which was I built a model of her and all her data and applied all the research and stuff in the world, and it came up with some suggested treatments. And this is after her treatment had failed, worked and then failed, and she'd been on immunotherapy and developed resistance, and she didn't have long to live. But actually, it surprised, and we were dealing with top oncologists, and one of the recommendations, they told the other two the drugs are not allowed to do that, or not licensed, but one of them, it was a good recommendation, and they recommended it for her. And the only reason we didn't go down that route was because she may have died in hospital, and she wanted to die home, so she didn't have the treatment. But it blew my mind away. The professor blew his mind away. That here I was having a top level, oncology conversation, and so I really realised that the be able to, it just changes the way we're all going to work. And the real benefit I think that we have as investors, that most people have a job, they have to do something. So their learning is like, at the end of the day, or, the real knowledge expanding. We just sit there and do that all day, figure the world out, learn and learn. Now in your hand, you've got an expert in most fields.
Yeah.
So you've got to learn how to think properly, but you can get up to speed very quickly. We spend a lot of time on things, learning and then doing the thinking. So it might take months to get me to do all that stuff, and then you can do the thinking. Well, now straight away. So that airports thing you were talking about, EasyJet. So I could see EasyJet earning high returns on capital. I couldn't figure out why. So the airport's commissions is perfect. They're studying and studying about whether to have another runway. So in there, a bit like the CMA, if you look at there, they commission all sorts of research. So in there, I came across this thing, which is the topography for anybody in London, how far they were to an airport and how much they would pay. And you saw basically the price premium for not being able to move and therefore the value of slots. And somebody, I think, called Frontier Economics, had done this work for the part of the process. And there was my penny drop moment, slot-constrained airports. That's why they earn high return on capital. They're not competing. But been on that for months and months and months. Well, now I might get there in a week. And that's quite profound for us.
I didn't think that was that difficult to work out, right?
People would say at the time, EasyJet and Ryanair are competing. And it's not the case. Ryanair's not in any slot-constrained airport. So we did the test. You may have seen that on that presentation. So we did 2,500 airport pairs. And so those are all the European cities where there's flights between. We did it for EasyJet and we did it for Ryanair. And at the time, the overlap was 4%. And yet between them, they did 40% of the traffic. So people keep talking about EasyJet's more expensive than Ryanair, so they can't compete. But they're not competing. They're in a different game. Operating out of Gatwick against British Airways is not competing against Ryanair. So that was a variant perceptions, people call it. And but it came down to, that's where the penny dropped for me. Yes.
But if you ask Michael O'Leary, he would have told you that he was competing against EasyJet.
He's not at Gatwick, and doesn't have any slots at Gatwick, and can't get into Gatwick, and so. And if they fly London to Paris by Ryanair, then, you go to Stansted and you arrive 100 miles north of Paris and you've got to get into Paris. And so are they in the same, if you want to go versus Gatwick to Charles de Gaulle? And to me, those two are not competing.
Well, they are competing because it's a competition on price and convenience. I know, I completely get it.
And the high return on capital for EasyJet just showed you it was on Caroline McCall and Andrew Finley just basically set a return on capital hurdle. And so they ended up in slot constrained airports. I'm not sure they had that insight, but she applied a capital discipline and undid all the flag planting that had gone beforehand and ended up in the places where you can earn high returns on capital. And that is not head-to-head against Ryanair in Stansted.
And you don't own EasyJet now, you own Ryanair.
We own Ryanair and we do own some EasyJet. Our problem with EasyJet was the people we backed changed. And it was a mistake we made. And we're in the process. There will be a time and the right value where we would reduce that. It's incredibly undervalued. We understand the thing we're afraid of isn't about to happen. The next time they come to be able to do a capital raise or place a big plane order, where we would worry about capital allocation skills. So, that's what happened. The CEO changed, then the CFO changed, and then they did one rights issue in COVID, and then they did a really dumb rights issue on the way out.
So just going back to AI, how much time are they spending? And are you getting any benefits yet? I mean, are the benefits down the road? I mean, just talk a little bit about how you think about that sort of investment benefit trade-off.
There's no management at Phoenix. We sort of hire a certain type of person who sort of doesn't, and probably doesn't even want to be managed. So I don't know what they do on a day-to-day basis. I meet them once a week. We're all in the same office, but we come together on a Friday afternoon and talk. But we already have the effects. Yes, I mean that those monitoring programs, those scraping tools. We've been analysing businesses where we can kind of check the geometric competitive landscape. We can look at where theirs are. We can see where the competitors are, the populations are. These are tools that are being built. We're also applying them in our own businesses. So in Dignity, we can figure out, where would you put a crematorium, or what would be the predicted number of funerals in these areas and stuff, because these are all tools that the team have built. So yeah, they're not just sandboxing. We're already using.
So you're already getting a net benefit.
Yeah, yes.
It's interesting. And this idea of running a fund which is investing in public companies and running a fund which invests in private companies. Can you talk a little bit about the difference from your perspective as a portfolio manager and why you wanted to go down that route?
Actually, I think Buffett summed it up quite well. It's even in his last annual report. As I said earlier, that the disconnect between the thing you modelled and what you get is usually for us is management. Now, the world can unfold in a way you didn't predict, so that accounts for part of it. But more often than not, our problem would be management, what they did with the money, how they allocated it. And when you own 5% or 10%, and I went down the route of, well, let's try and get other shareholders and do things. That's a thankless task. Get 4 other fund managers. They might agree on a day. By the time you got to the EGM, they've changed their minds. And then we would put someone on the board. And I thought it's been good for the team to put them on boards to try to influence, but I can't really point to any impact we've ever had for all the work that's gone into using those. We've learned a lot, but we haven't. So we just don't do that anymore. But if you have control, if you own that thing, then you get to choose who runs it. So you protect yourself from all of those things. So that then you'll get the underlying returns of the business. If you have a problem with management, you can change management. If they're going to do something done with capital, you can say no. And that's the benefit we get. So there's maybe a wonderful business, but not the right management, and we couldn't make the investment. And sometimes you can buy whole businesses inexpensively. But that same domain knowledge, sometimes there are wonderful businesses trading cheap. If we try to buy all of Burberry, we want to buy it for $2 billion. We'd have to pay $5 billion. So that same expertise can be applied in a way where you can have a little bit of a wonderful business when they occasionally trade cheaply, and you wouldn't be able to pay that price you bought all of it. And every so often you can buy a business, and you want to buy a business you can own forever, it is different. And we've had a lot of learning from doing it. It's much more difficult in practice. But again, we apply the same continuous improvement. But I think it's wonderful to be able to do both. And they're very complementary.
And I mean, do you see that as one of your core skills, assessing people?
It is something we take very seriously. I'm married to a psychologist, so I've been sort of under assessment for 35 years. And so at the beginning, what I did is I'd use body language to try to assess people or their words. And then and we'd spend a long time constructing our meetings with management to try, because people don't volunteer the difficult information. And so there are different ways of asking things. And we spend a lot of time trying to think about how do we get management to talk about something. But yeah, it's so important. Judging people, judging customers, consumers, how they're changing. So the psychology of human beings and human motivation is a really important part of what we do.
So how do you get management to talk about the things you don't want to talk about?
I get to share my techniques. Because we recently did something, and the analysts, knowing what the technique was, nearly burst out laughing in the middle of the meeting. So
I don't want you to share any secrets. I just think it's quite an interesting area because investors generally aren't very good at running management meetings, I would say.
Yes.
And some of them are getting a bit of experience. There are companies that train people to do better. I do a sort of simplified version of this, but it is just about, well, how do you get the answer you want? Yeah. And I just do. I'm not sophisticated about this, and I don't think it's a particular skill. But one of the things that I see people do a lot is they ask very long, complicated, rambling questions. And if you ask a 3-part question, you'll never get the answers to the 3 parts. So
I'll give you. Okay. So firstly, we don't have a meeting with management until the end. So be an expert when you arrive.
Yeah.
Don't be educated by management, because you won't know what you don't know. We would rather see a competitor first. So before we met the Hargreaves management, we would meet AJ Bell. And so if you really want to learn about management's weaknesses, hear it from their competitors. People are very happy to share. So go in with, and then also try to have something useful that you know in detail. But I would say my tactic is be friendly. We always go in multiples, so never go on your own. Writing down, trying to do the questions and stuff, and then trying to remember afterwards. My memory's not what it was, but I used to have a complete recall. I could play the meeting back.
Oh, really?
So I could go back to it and do. But still, you discuss it and say, yeah, did you notice he looked across at him? Did you notice they looked at each other when you said that? Now that you could miss that. So having multiple people in the room. So we would plan for a 1 hour meeting, might spend 4 or 6 hours thinking it through.
Really?
Of what we're trying to get out of it. And this is when I teach it. I'm teaching, saying, what actually are we trying to learn? And let's hypothesize that this is the case. How will we get that out? How will we get to this point of view? And how will we get someone to share something, not price sensitive, but just maybe commercially sensitive? And there are various techniques. And, you can put words in people's mouths, you put numbers and people correct you, or their face will tell you something. So there are ways to get things that you think are important. So I'm not trying to be clever. So integrity, I'm really trying to get something where people need to contradict themselves. So I keep a piece of information that I know. I take them down a path where they might agree. I later on produce a piece of information. Do they contradict themselves because they care about being correct and truthful, or is the appearance more important? And do they therefore sort of, they were, not dishonest, but slightly untrue? And you just learn something about them. We're trying to make those assessments about what type of management, because when we judge integrity, we have it on a range. So you have it, you don't have it. You have it. Are you very open and tell me all the negatives? That's nice. They're very rare. You just don't lie. And the weakest one is, I just won't lie. You'll have to answer me the right question. I won't tell you an untruth. And unfortunately, the disclosure rules and stuff have made managements more closed up than they used to be.
And people, I mean, they're salespeople these days.
Yeah.
I mean, you're dealing with UK management, so it's not as bad as it is in the United States, where...
And I would say if a management's in the public domain, don't have the meeting. I do think, like you said, so we have a charisma, a red flag. So if you're going to see Mike Ashton, Mike's highly charismatic. You'll come out wanting to buy the shares. So we have a charisma down there. So it's a red flag to begin with. And we say, have a cooling off period. So we're aware, but being with a charisma is terrible. You better not see management at all. I like it if someone else is, so I'll send the team out to do management meetings. Most of the time it removes me. It makes it easier for me to be objective about them. But if someone's doing a recorded Q&A and stuff, they're in the public domain, you've probably got all the information you need, especially from a larger company, to make the assessment without getting all the biases that happen as soon as you sit in front of someone.
And how do you stay detached when you're owning the stock for a long time and you become friendly with the management? You must do. I mean, you've owned Barrett's for how many years?
Yes, but I've not owned it for 4 times during that 26 years. And the same with Fraser's, we almost went down to nothing. So first is have the kind of relationship where that's not a baggage between you. So I think Mike would say he knows when he's doing well if we're selling that. So that means there's not like I owe you, I'm going to have the stock. So I scenarioise that, get comfortable with it, make sure there's no quid pro quo. It's not supported, not supported. We're rational investors. We say, you've got to, and if the shares are trading well where you're taking money off the table, the management are perfectly happy. They're already getting rewarded for that. So a nuisance value guy coming off the register is not an issue for them. So we have been willing to sell things. It doesn't seem to be. Endowment bias is something we worry about a lot. That the bias that you have from holding something. So, and a lot of errors we've had have been endowment bias, and a lot of corrections to our process that came out of that. But we've been quite willing to not have a holding, or to reduce the holding, put it back on, try to do the rational. thing. What I have learned through time is the probability of being correct. So a stock that you've owned for a long period of time and had lots of access to, the value of that is very high in terms of how likely you are to be right or wrong about the future versus something new. And in my early days, I've done that into the next thing for pick up another 10%, and off I was gone. So we don't do that so lightly anymore. Put a high value on the expertise that's been accumulated.
But you're still happy to sell?
Because it's a valuation thing in the end. So there has to be a price level. Now you've got different, there's not one value.
No, sure.
But ultimately, if we buy a pound for 50p and it's selling for a pound, and I've got other pounds for 50p, I ought to be making the switch.
Are you? I don't know. What's your turnover been like? I mean, it's been pretty low, hasn't it?
I think it's pretty low. If you take out dealing with money coming in and out, in some years it's single digits. The highest it's ever been was in 2008, where I think it was close to 100%. So when there's a lot going on, there's a lot of opportunity at beyond. So it'll probably average out in the teens. I think most of the capital's already allocated, is how I feel. You found the business, you've made the investment, you're monitoring the management, we're happy with it, it's in the right hands, job done. So I'm really allocating capital at the margin, the dividend money that comes in and things that you trim and stuff. So, that's a 10 to 20% job of allocation, not the 80%, if you've got those right.
And, I mean, you've got it right. You've got it right. The stock hasn't performed. What do you do? I mean, you've got fundamentals right. But
Yeah.
Because I was interested, you said you don't take any sell-side research. And I always wonder about that, because I always think if you don't take any sell-side research, how do you know what's in the price? How do you know what the stock market's thinking?
I mean, I do sometimes go and look at what that thinking is, if we built an expertise. So I think it's terrible to go into a field via someone else's opinion.
Right, okay.
So primary first principles research thinking, because it's about a business. So go and see people. Don't read people's opinions, because you don't, unless you know the person, you don't know how to interpret. You don't know what they've left out. You don't know what their baggage is. But if someone's offering you a pound, I always had to say, if we put a desk outside of Phoenix and we were selling pounds for 50p, do you think people would come and buy? People say there must be a catch. Now, I haven't actually done the experiment, just in case it catches on and people figure out what you're doing. But you want to know why. So you're right about that. So what is, not necessarily read the research, but try to understand how the world looks at things. Or I'll go and look at the forward earnings estimates. And one of the problems we have is we model cash, not earnings. And some of our best opportunities are where cash and earnings look different. They just don't come through in the same way, like in, say, house building. So I'll have a look so I had to rebuild our models as like an earnings model. So say, well, do I disagree with what the analysts are saying? They're modeling something else called income or accounting income or something. So what does our model look like that? And then I can see the difference. So then I can see when their numbers will change and things. So I've done exercises like that. I've been through stages where I've tried to get analysts to come and, I've given up this a long time ago, but I remember in sort of 2010, 11, and Barrett shares were £1, and we were trying to get the company to buy them back. And I'd have people giving me all sorts of pessimism. And I say, come to our office, honestly, write on the board your scenario. Let's count the cash. Let's just see if you can. And nobody ever took me up on those things. I've given up on ever trying to get analysts to change views. So I think they were in a difficult game. I don't think there'll be many of them in 2 years. But
in 2 years,
I can produce some of the stuff we've done recently, where we've asked certain types of questions and put it together into one deep research report. That's better than any work I've seen analysts do. So they're going to become prompt engineers. So maybe you need one to do the job of 10, and there'll be a few of them, but the fund manager could do that themselves. So what's the role of the analyst? So I just don't see that that's got any value anymore. I can definitely see AI can do a better job.
That's very interesting because normally when you talk to most people, they're worried about hallucination and those sorts of issues. And
I just run the same prompt on at least 2. I've got 4 that I use all the time. ChatGPT and Gemini and Claude and DeepSeek, and I just copy the prompt and run it in all 4. If it's a report 2 or 3, you can see the hallucination straight away. The probability that they both hallucinate in the same way is very, very low. It's coming down a lot, and if you are being hallucinated too, if you're in a field where you don't, then that's a bit dangerous. But we're using stuff where you've already got some domain knowledge, so you should spot the hallucination. So it's more that those hallucinations are a much more milder weakness than the quality of the research we see. I think analysts are in a really difficult job. I mean, we are very comfortable with the idea that there's no relationship between fundamentals and share prices under 3 years. I think plenty of academic studies have done this and proved this. And yet analysts are being judged off a shorter time frame. So in the shorter time frame, it's a random walk. Now, if analysts really were in the business of, say, predicting lottery numbers, because that's their job. Now, you write an incredible report, and then it comes out 22, and you said the number will be 23, and you say you almost got it right, and then you explain why you got it slightly low, and you estimate the lottery numbers for next Saturday, and then you get them wrong, and then you say, well, that's because this and this happened, and Trump said this, Trump said that. So they are trying to intelligently interpret a random walk. I think it's a thankless task. The quality research, the good analysts, the thing that actually they may be able to bring is if you've been in a sector for 20 years, you know your way around, you know who's good, you know about management, and that is a useful piece of information. Those people could probably work on the corporate advisory side and breach. But I think the producing a piece of research about what's going on at Lloyd's or something, I think the fund manager could do that for themselves by just typing in a prompt.
That's interesting. I mean, obviously, the sell side has been reduced in quality and reduced in cost because there isn't the revenues available, particularly in the UK or in Europe, less so in the US.
I'll give you an example. So Glaxo, we've owned Glaxo before. We have a top-level understanding and insight about pharmaceuticals that actually the value is not in drug discovery. It is in being able to take an idea and distribute it. And that's why big pharma companies are the same people as they were 100 years ago or 50 years ago, same leadership, even though what they're selling has completely changed. But the world has been changing. So we wanted to understand how the regulations have changed to allow companies to go longer before they sold out to pharma. So we did a deep research report on that. It did all the case studies, showed all the regulations, how they changed, and how COVID had changed them to show how people could go all the way through towards before they had to sell out to big pharma. In the past, that would be big pharma. So it lowered the cost of getting a usable drug. And then we were on patent cliffs. So we wanted to simulate. So we've got 40 years of patent. Now we knew the issue with patent cliffs. So 40 years of simulation of patent cliffs. Put those 2 models together and ask them to build a 10-year view of what might happen and stuff. So this is incredibly good work. That was the report that was quite, and it was enough for us just not to make the investment. Just like the world's changed, the way we thought. And I spent probably 15, 20 years on that sector. I've probably read 30 books. And we studied like 40 years of pharma annual reports when the analysts went through. So it took nearly a year to do all that work to basically we put all as if Glaxo had always been together, and we showed that the market shares were very stable, incredibly stable. Yeah. If you took out the M&A, and we managed to me and the analysts working on this. We did this in a week, and really? It would have been 5 or 6 months' work to reject that investment. So that opened me up to so. Some smart analysts are going to start producing some very interesting piece of work, very different from what they've done before. And maybe there's a role there, but they've got to change the nature of the job.
Well, it's very interesting you say that, because I really shy away from using AI to produce anything. So I'll do some, so I'm writing my Substack this morning before we met, and I was doing some work on this particular commodity market, and it's not a lot easier to do the work using AI because you don't, it just shortens the research process. But the idea of having it write what I'm going to write scares me.
Yes.
And so I like to do all that myself. And
well,
maybe
I think the final bit's got to be you, and you'd feel the difference. My wife's writing a book at the moment, and she's always wanted to write a book, but she also think it would take her too long to research. And I said, you've got now an expert. She's doing her research, it's Ottoman history and stuff like that, but she can do it all in a way that she'd previously have gone off to a library in Istanbul and all this stuff, and now it's accelerating. Talking to me at 4 a.m. about how it's all coming together, but the actual end piece, I still think there's a lot of stuff that needs to be authentically human. It's the same with the oncology. You don't want a tool to tell you you've got cancer and how you're going to deal with it. That's a human thing. The human gets augmented. So when Kasparov lost to Deep Blue in chess, he went off and did a whole doing AI, working with Oxford, and he started a tournament called Centaur chess, so man and machine. And what was interesting in that, it wasn't the best chess player and the best software. It was the best combination.
Yeah,
the people who understood what this software could do were the best performers. And I think it's the same with AI. You've got to sort of augment yourself and do the best bits that are human. Because I did ask myself, does value investing have a thing? But actually, the essence of what our edge is doesn't go away because of AI. We get augmented by it, providing we do embrace it. But if you were starting as a value investor today, will you ever need a team? Will you have an agent to do the fund reporting? You'd have an agent to do this. You'd have an agent to do that, and so you do need someone so you don't go mad. But otherwise, you can do a lot just with tools.
So you need less people.
You do the route to go down that route. We've made a virtue of the way we do it. It's a team-based approach. So they're not, our team are not building their future replacements, but they are very augmented. So the amount of productivity I expect out of them is much higher. Our reach, we've always operated in our circle of competence. Our ability to increase the circle of competence has been really scaled up. We'll take it cautiously, but that's what I see.
Okay. Really fascinating talking to you. I always finish by asking people to recommend a book. And I know you've got a library on your website. No, you've got a library in the office. I've not visited your office, but...
Yeah. We have a lot of books. And then that's just a selection. Because I think one of my ways I used to pitch people coming to it says, I'll save you reading lots of rubbish business books because most of them are not great. So I try to find the 1 or 2 or 3 books in a field that you should read. If I meet somebody in a field, say, "What's the best book in your field?" and then just read that, not read all the less good ones. So, to me, the part that still is underestimated and understood is psychology. So I would say Daniel Kahneman's Thinking Fast and Slow, and it's a book to read slowly. If you read that in a weekend, there's something wrong. It's like each page is being lovingly. It's like a Bible, and think about what it's teaching you. So it's a thing to take 6 months reading and going back to. And if you don't have the time to read all of the book, if you've read the first 100 pages, I think you've got 80% of it. But I think that's profound. So I've got 2 twin pillars. It's Buffett and Kahneman. And I think it's the psychology side is still underestimated.
And would you recommend any books on Buffett? Or
I think people are affected in different ways. I mean, that the Roger Lowenstein book is written so well; it inspired me in all sorts of ways, but it doesn't tell you how to invest. Robert Hashbomb has written better books about what it is and his process. Snowball's really fascinating because you get inside of his character. He may not have liked it. So
have you read Alex Morris's book? he's gone through all the AGMs.
Oh, yes. So, all the transcripts are available. So I built all these sort of individual GPTs. So I built something called Ask Warren. And I've even given it Warren's voice. And so I've loaded every transcript and every chairman's letter. So, because what happens is, I do recommend people go and read the letters. There's a lot of them, and there's a lot of AGM transcripts and questions. So if you ask it, what does Warren say about software, or what does he say about integrity, then Ask Warren gives you quite a good summary. So I would say for things like that now, where there's a lot of information, dump it in one GPT and then query it. And then, or you could say, build me a 10-page summary of things, or, the thing you wanted to learn. But yeah, there's nothing like reading the real thing and traveling his journey from the original partnership letters all the way through.
No, absolutely.
But that's not for everybody, isn't it? So,
well, you've got to be a bit of a geek, I suppose, to do that.
And then it's diminishing returns. There's always something new. But if you've read the last 50 years, then this year's will have, 5% of it will be something new, and the rest is stuff you've already heard.
But it's good stuff, so I don't
brilliant.
mind reading it. We're recording this at the end of April. We're recording it on a Tuesday. I'm flying to Omaha on Thursday, and funny, the actual meeting itself is, it's fun to do, but it's more the whole atmosphere around it.
Yes, it has become a whole ecosystem, and I used to go every year, but it's the same time as my wedding anniversary. So once they started Yahoo streaming it, I no longer went. I mean, we have sort of hosted it, in our boardroom. If anyone wants to spend Saturdays sat in our boardroom watching it, or somewhere else. But you're right. There's always one of our team's going. Michelle Carter is going to be there, and I think I always say that if you're a Christian and you're around in the time of Jesus, you want to go and see him at least once. And so I do think there's a lot you get out of it.
Gary, thanks a lot.
I wish I'd started on the management meetings, as I was really interested in Gary's approach. I was a bit worried when he thought that analysis would be basically an AI task in 2 years. I think he may be being a bit overambitious. But there's no question that Gary's an incredibly thoughtful investor, and he's developed an approach which we can learn from. He was understandably reluctant to share too many trade secrets, but I learned a lot, and hopefully you got something out of it also. Thank you for listening. Remember, the best way you can support this podcast is to share it with your friends. You can also leave a 5-star rating in Apple Podcasts or Spotify, or even leave a review. I really appreciate your support. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel, and why not visit our website behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.